Hello, and welcome to episode 9 of the Life and Finances Together podcast. Today, our financial professionals, Roger David and Jake Reinfeldt, will be talking about some of the do's and don'ts of Roth conversions. It's a popular financial topic and a frequent Google search, along with questions like, what is a Roth conversion? Is it right for me? And what are the rules for this kind of investment? So let's find out the answers to these questions and more. Roger?
There's a lot of things out there when we're looking at Roth conversions. I mean, that's the new buzzword. That's the new financial planning strategy that everybody seems to want to know about and actually want to complete. It's like, well, there's a few more things you got to consider before you start really looking at doing the Roth conversion. So we know it's a very popular strategy, but there's a lot of things to think about. There's a lot of things that can go wrong where you can get yourself into some financial trouble and maybe even a little bit of trouble with the IRS and the tax man. So, which leads to the first big consideration, and that's going to be taxes. I mean, when you're considering to do a Roth conversion, first thing you need to look at is taxes from a number of different perspectives.
Yeah, exactly right. And the taxes is the name of the game, right? You have to consider, first and foremost, when we're determining, okay, how much of my traditional IRA money am I going to convert to a Roth IRA? Well, you've got to factor your income taxes in. And first and foremost, we look at the federal income taxes.
Right.
So one of the discussions when you're determining how much to convert is, how do we go about doing this? Do we do just a large lump sum in the current year, convert a huge chunk of IRA money to Roth? That's usually not the best strategy because you're going to run up the tax schedule and put yourself into a much higher tax bracket. So typically, the better strategy is to, over a period of time, convert this IRA money to Roth money. Determining what makes the most sense, you really need to reference the federal income tax brackets. You need to look at each bracket, kind of see based on your tax return where you sit. You can look at last year's, but also need to kind of project where you're going to be this year with the amount of income that you know that you have. And what we often will implement for clients is running up their tax bracket or running up the tax schedule, filling in their current bracket. So if they're $20,000, $30,000 into the 12% tax bracket, well, we're going to see how much we can convert while still keeping them in the 12% tax bracket so that you're not paying this extra amount of income taxes on the conversion.
You can see how much income you have available in each one of the brackets, right? So you need to be aware of that, right? I mean, how much
exactly.
you might have in a given year.
Yep. You got to really see where you fall right now in the tax bracket, and that can kind of help determine, okay, each year, how much should we be converting? But it is something that you have to reference every year because the tax brackets, the amounts that go into each can change, the standard deductions can change, et cetera.
Your income can change.
Yeah, your income can change as well. So you have to factor that in. And it's not only this year, but you have to look going forward. You have to kind of determine where you're going to be in future years as well. Because you could have more income coming in future years. If you're still working and you expect pay increases, large bonuses, commissions, you might be in a lower tax bracket.
Right.
Because you're retired, you're not going to be earning the same amount of income that you've been earning. You may be enrolled in Social Security and you have to withdraw less money in retirement. Well, you may be in a lower tax bracket. Big picture, you can talk all day about, hey, our country has $35 trillion of debt and growing, and some president down the line is going to have to raise our income taxes. That's something that we hear pretty often, but we don't know for sure. We can only work.
I don't
with
think
what we know.
you're not getting elected with that.
Exactly
stance on
right.
there.
Yeah. No.
Jake's not actually going to be running for office anytime soon with that comment.
But it really is. It's kind of what we call in finance an arbitrage opportunity, right? You want to pay the taxes on this money when you think that you're going to be in a lower tax bracket.
Right.
And all that we know are the knowns. We know what the current tax law is. We know that if nothing changes short term, that the tax law is going to sunset. And you really have to work with what we know, and in particular, your specific income tax situation. You need to know where you are in the bracket, how much we can convert, and what makes the most sense for each client. And it is different for every client because every situation is different. If you know, for example, that you're going to be making less money next year, you may want to wait until next year to do some of this conversion because you can fill up the tax bracket a little bit more. You can convert a larger chunk of money. If you know you're going to be making more income next year, then you may want to convert more in 2024, for example. So federal taxes is a huge thing, but you also have to factor in your state income taxes. Each state has different rules for income taxes. If you know, for example, that you're retired, you're going to be moving to Florida for retirement from the state of Michigan, you're going from a state that pays state income taxes to one that has no state income tax in Florida. So that's another piece of coordination with this as well. You've got to factor in what state income taxes will I be paying. If I'm moving to Florida, I may want to wait until I've completed that move, where I'm not going to have to pay any state income taxes on that conversion. So that's just one example with Florida, but there's even changes coming soon in the state of Michigan.
Yeah, I mean, the state of Michigan, there was a 4-year phase out of taxation on withdrawals from 401ks and IRAs and on pensions, and in 2026 there's going to be elimination of state of Michigan income tax on those withdrawals.
Exactly.
So if you're ramping up now and thinking, well, I'm going to convert a whole bunch of money, from my traditional IRA to a Roth right now, I don't know. You may be wanting to wait. It depends on the amount that you're going to convert and what taxes you probably pay on to the state of Michigan when you actually do the conversion. And this is something that people are ignoring because they're just blindly saying, they're just looking at what's going on from the federal standpoint. So there's so many more things to look at, and every state's different. They have different ways of looking at Roth conversions and how they're going to be taxed. So you're going to have to understand, what's going on with that. So, I mean, it always comes down to taxes and then taxes and then taxes again,
Exactly.
right? I mean, that's what we're looking at. I mean, that's if you're not thinking about that and you're thinking about this strategy, just saying, well, everybody's talking about it and everybody's saying that, hey, it's going to be the best thing for me to do or my family to do, you're going to want to look at this and make sure that it actually is. I mean, like we always say all the time, right? You got to do the math first before you're going to do anything.
Exactly.
I mean, that's the most important. But if you're in the state of Michigan, you better coordinate with your tax advisor to see what the best timing may be to do any kind of sizable conversions, given there's no more state of Michigan tax, again, on 401k, IRA withdrawals, and also on pensions. I mean, that's a pretty big deal that people are missing out.
Yeah, and this coordination with taxes really is to avoid converting too much at one time, right? You want to make sure that you're not converting too much if it's going to drastically impact your income taxes.
Yeah, in most cases, it's going to make sense to do it over a period of time. And the other thing, too, is what you have to look at. One of the things that, we talk about taxes and everything, but one of the other things is cash flow. Right? I mean, that's one thing too, is you got to make sure that you're not going to put yourself in an adverse situation, especially if you're retired from a cash flow standpoint. Do you have liquid savings? Do you have savings outside of IRAs? You're going to want to watch that. So, I mean, one of the other things too that's just absolutely missed, and it gets a little bit technical. A lot of tax advisors will have to correct a lot of financial advisors' work, is this pro rata rule. Right. So when you're looking at, and this relates to this thing called a backdoor Roth IRA conversion, right? And this is usually applicable to high income earners, right? Exactly. Those that can't contribute to a Roth because basically you just make too much money, right? So when you make too much money, they're going to take away certain things from you. And one of those is being able to contribute to a Roth in the traditional sense. So what a lot of high income earners will do is they will say, okay, I'm going to take some money and I'm going to put it into a traditional IRA, and they don't get a deduction for that. So that money goes in without a tax deduction into a traditional IRA, and that happens on Monday. And let's say that's $7,000, right? You put $7,000 in, with the idea that on Tuesday, you're going to convert that traditional IRA, right? This is called the backdoor IRA. You're going to convert that on Tuesday. Now, there's no earnings because you just put it in. So the idea is, hey, I'm going to convert this traditional IRA to a Roth IRA, and this is going to be great. Right? I was able to get money into a Roth, and it's going to continue to grow tax-free. Well, not so fast.
Exactly.
Because the IRS says, hey, hold on a minute. We got this little thing called a pro rata rule. And what that means is they're going to take a look at all of your retirement assets. They're going to look at your IRA, simple IRA, your SEP IRAs, and they're going to add that together with any after-tax accounts, basically a Roth that you have. And they're going to look at what the ratio is to pre-tax versus after-tax. So Let's just say you have $1 million in retirement assets. 900,000 of it's sitting in IRAs, SEP IRAs, simple IRAs. This doesn't apply to 401ks or 403bs, major plans that you have through your employer. So we're looking at kind of those IRA type of assets where it's all pre-tax dollars. So let's say you got 900,000 out of $1 million that's sitting in those IRAs, and 100,000 is sitting over in the Roth. Well, that's a 90% ratio of pre-tax versus after-tax. So when you do the conversion of $7,000 to this backdoor Roth, you know what's going to happen? Well, what is it? It's going to be, what am I saying, 6,300. Geez, I had to do the math there for a second. I'm like, oh, man, we do the math much better in the office. But you're going to have now $6,300 of this backdoor Roth that's going to be what? Included in taxable income. And you know what really hurts with that? That's double taxed. Because you get to pay tax on that $6,300. We just put after-tax dollars in that account. And now, because of the pro rata rule, to try to do this backdoor Roth, you're going to pay income tax on $6,300.
Yep, 90% of it.
Can you believe it? I mean, that's incredible. That's double taxation.
Yep. It's a huge thing that's missed.
Welcome to the IRS and the fun that goes with knowing all these rules and trying to make sure that you're on top of it. So, I mean, again, these are complicated things. I mean, this pro rata rule gets missed quite a bit. And you have to make sure that you're on top of that. And you have to make sure that you understand what those rules are. And then if you do this, participate in this backdoor Roth, and let's say, you say, well, I'm okay with double taxation and everything else, then what do you get to do? You got to track it, right? So you're going to have to make sure that you're on top of these things for future years, not just when you're doing the initial conversion here, the backdoor Roth. Hey, you're going to have to figure out what you're going to do going forward. I mean, that's what's going to happen.
Yeah, exactly. So let's just say you come up with a perfect plan. You're factoring in the taxes on we're not talking backdoor Roth anymore. We're talking just regular conversions.
Right.
You factor in all the taxes. You understand what your state income taxes are going to be. You've got a perfect plan. But you have no cash to pay the tax bill on the conversion, right? We typically will advise the clients the best scenario for completing a Roth conversion is to have cash saved up to pay for the taxes due.
And that was the original idea, right? I mean, that's
really
how this strategy all came about.
Yep, but now that this Roth conversion is such a big buzzword and everyone's trying to implement it, build it into their financial plan and implement the strategy, a lot of people have not saved up enough cash to pay that tax bill. It's not as advantageous when you don't have that cash, because what does that mean? You're going to have to withhold or pay for the taxes out of the converted amount.
It's a pretty big hit.
Yeah, it really is. So
I mean, what's that percentage? It could be like 30%.
Yeah,
right?
It really could be. So when you're looking, just as a kind of pure example here, let's say that you determined you wanted to convert $10,000 from your IRA to a Roth. Through all the math that you've done, all the planning, $10,000 is your sweet spot. But you don't have the cash to pay for it. So what you'll have to do is convert $10,000, but also withhold your federal and possibly state income taxes before it goes into the Roth so you can pay the tax bill. Now you've got what was $10,000 of IRA money is now $7,000 of Roth IRA money. So you can just see there, by the basic math, you're kind of taking a step backwards. You've got less now retirement assets that are moving into this Roth. You've got less shares, and you've got less of a balance of the account that will continue to grow, compounding later into your retirement. So you're kind of taking a step backwards on your financial plan in some scenarios, and we see it often when we're drafting this for clients in their financial plans. If you've got to pay for the conversion through tax withholding instead of paying cash for it, dollar for dollar, you've got less funds inside of this Roth IRA that won't grow as fast over time.
Right. And the other thing, too, is now you're going to start depleting, if you're retired, you're going to start depleting your cash reserve in an effort to, pay the taxes on the conversion. So let's say you do have the cash. If you have the cash and you're paying the taxes, well, you better coordinate that with what your needs are, especially during retirement. Because what we do is we're going to try to coordinate the use of some of that liquid savings along with IRA withdrawals to potentially keep you in a lower tax bracket for maybe a good portion of the early years of the first years of your retirement. And if you start using up all of that cash, and all of a sudden all you have left is IRA money.
Yeah.
right? Maybe some Roth money. But, I mean, so you've got to be careful with what you're doing there. It goes beyond, we talk so much about taxes, but it also has to coordinate with your financial plan and what your needs are going to be when it comes to, your cash flow and what your lifestyle needs are going to be. One of the things, too, that kind of gets missed is this 5-year rule, right? Everybody kind of understands, say, look, if you have a Roth IRA, there's this 5-year rule, right? You have to wait, you open up the Roth IRA account, and you have 5 years before you can withdraw their earnings tax-free. Well, when you're doing a conversion, what gets missed quite a bit is this 5-year rule applies to each conversion. So it's not just when you open up the IRA to complete your first conversion. Every conversion you do in that Roth IRA gets a separate schedule.
Yep.
So what else do you get to do there? Oh, you get to track that, right? So let's say you're going to be doing this over a 10-year period of time. Well, at any point in time, if you want to start withdrawing, let's say it's in that 10-year period, during that 10-year period, at any time, you're going to have to figure out, hey, how much have I converted and how much is eligible for withdrawal on a tax-free basis and how much isn't? Because again, can't stress enough, each conversion gets a 5-year schedule, right? You got to make sure that you understand that. And then there's also the issues when you're looking at Medicare. So if you're retired, there's issues with that, right?
Yeah.
I mean, you could pay higher premiums.
This conversion is taxable income. Well, that taxable income not only affects how much you're paying in taxes, but can also impact Social Security taxation,
right?
But also can factor into the calculation of your AGI, which determines how much you're paying for your Medicare premiums. So if you convert a nice sum of money from IRA to Roth in 2024, and you've increased your adjusted gross income by a certain dollar amount where you've exceeded the threshold for the Medicare Part B premiums or Part D or whichever you're enrolled in, you may have to pay this extra surcharge, this extra premium or this IRMA on your Medicare premiums for an entire 12-month period of time. But it doesn't hit right away, does it, Roger?
No, you got to. It takes about a year for them to catch up with you, as it relates to this. So when you look at doing these Roth conversions, right, no matter what strategy you're adopting or what methodology, you're looking at doing it gradually. You're looking at possibly maybe a backdoor. There's so many different things, so many different tables that you actually got to be aware of just from the simple standpoint of, hey, I better check that table, or hey, I better do the math on my financial plan. As you look at this strategy, is it an effective strategy? It could very well be, right? One of the things too is when you do these conversions and you got to be careful with some of these things. When you're running the calculations, right? We call it doing the math here in our office. Anything's going to look good the longer that you live, right? Because you got more time to make up for a possible mistake that you made. So you have to be careful with that. And when you're looking at whether you should be doing or not, there should be some kind of break-even analysis that you look at as well. And a lot of times when we do the math on this, you're going to see that at the end of life, and we kind of project out in our financial plans to age 90, you're actually going to have a smaller capital base than if you did no conversion, right? It'll be smaller.
Often,
but then you got to peel back that onion a little bit and say, well, I know that the total capital base is a little bit less, but you might have 90% of that capital base now is tax-free, not subject to any taxation. So there's a number of different things that you have to look at. It gets very complicated. You have to do the math. You have to do the calculation. And guess what? What your neighbor's doing is not necessarily what you should be doing. Everybody's situation is different. If you're not doing the math and looking what the impact is on your financial plan, then you could get yourself into trouble, both from a taxation standpoint and also from your financial well-being and your cash flow situation. So there's a lot of things to consider. There's a lot of tables. There's a lot of factors to understand. You need to do the math when you're thinking about Roth conversion. Be careful. Understand what you're doing. Understand what the impact is on your individual situation, right? And just again, like we say all the time, do the math.
Thanks so much for watching, for listening, and for learning more about the do's and don'ts of Roth conversions with us today. If you have any questions about this particular topic, our financial services, or finances in general, please check out our website. That's reinveltdavid.com. Send us an email, give us a call, and of course, please like and subscribe to our podcast and stay tuned for our next episode.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.